I want you to imagine a fortress. It is old, it is massive, and for decades it has been impenetrable. Inside this fortress is the control mechanism for the global price of silver. For 50 years, the walls of this fortress have held back the tide of inflation, the tide of industrial demand, and the tide of monetary debasement. The gatekeepers, the bullion banks, the regulators, the establishment, have sat comfortably inside, pulling levers and pushing buttons to keep the price exactly where they want it. But something changed this week. For the first time in a generation, the gatekeepers are looking out the window and they are scared. They see an army approaching that they cannot stop. It is not an army of retail investors. It is not an army of Reddit traders. It is an army of foreign banks, sovereign wealth funds, and industrial giants, and they are battering down the gates. We are witnessing a raid on the U.S. silver market that is unprecedented in its scale and sophistication. The fortress is being breached. What we are seeing on the charts right now is not a normal rally. It is not a bull market in the traditional sense. It is a hostile takeover of the physical silver supply. The price action is violent. It is erratic. It refuses to correct. Every time the price dips, a massive hand steps in and buys everything in sight. This is the behavior of a buyer who is desperate. This is the behavior of a buyer who knows that the window to acquire metal is closing. Today, we are going to go deep inside this raid. We are going to look at the anomalous data in the futures market that proves something is broken. We are going to expose the non-US bank short position that everyone is misinterpreting. And we are going to explain why the path to four-digit silver is no longer a fantasy, but a mathematical probability driven by the collapse of the control grid. If you hold silver or if you are thinking about buying silver, you need to understand the battlefield. You need to understand that you are no longer just betting on a metal. You are betting on the failure of a suppression scheme that has lasted since the 1970s. The raid has begun. The raiders are at the gate, and the prize is the most undervalued asset on planet Earth. Let's start by analyzing the price anomalies because they are the footprints of the giant. In a normal market, price moves in waves. It goes up, it gets overbought. Profit takers sell, it goes down, it consolidates, and then it goes up again. It breathes. What we are seeing now is a market that is holding its breath. The price spikes up, pauses, and then spikes again. There is no exhale, there is no correction. Why does this happen? It happens when the sellers have disappeared. It happens when the ask side of the order book is thin. But more importantly, it happens when the buyers are not price sensitive. A normal investor looks at silver at $90 and says, "That's expensive, I'll wait for a pullback." The buyers driving this market right now are looking at silver at $90 and saying, "I don't care, give me the metal." Who buys like that? Industry buys like that. If you are a missile manufacturer or a solar panel giant, you cannot wait for a pullback. If you run out of silver, your factory shuts down. You lose millions of dollars a day. So you pay the market price, whatever it is. Sovereigns buy like that. If you are China or Russia and you are trying to de-dollarize your reserves, you don't care about a few dollars on the spot price. You care about securing the asset before the US dollar collapses or sanctions hit. These are the whales that are raiding the market. They are eating the inventory that usually provides the buffer for the price. Now let's look at the futures market because this is where the crime scene evidence is located. We need to talk about open interest. Open interest is the total number of outstanding contracts, the bets placed on the price. Typically, when the price of silver rises, open interest rises because the banks are selling new paper contracts to cap the price. They flood the market with paper silver to dilute the demand. This is the classic suppression mechanic. When they do this, the price usually stalls or falls. But look at what is happening now. Open interest is skyrocketing to record levels, yet the price is still rising. The mechanism is broken. The banks are throwing paper at the fire, and the fire is burning the paper. The market is absorbing the shorts and asking for more. This is a signal failure for the control grid. It means that the demand for silver is stronger than the bank's ability to print contracts. Furthermore, we are seeing activity in the back months, contracts for delivery 6 months or a year from now. This is unusual. Speculators usually play the front month for quick gains. Activity in the back months suggests that major players are locking in supply for the future. They are hedging against a long-term shortage. They are terrified that in 2027 there won't be any silver left to buy. This brings us to the most controversial data point, the Bank Participation Report. This report shows us what the big banks are doing, and it shows a massive divergence. The U.S. banks, like J.P. Morgan historically, are relatively balanced. They are not heavily short, but the non-U.S. banks, the foreign banks, are massively net short. The internet conspiracy theorists look at this and scream, "Manipulation! The foreigners are suppressing the price." But I want you to look deeper. Why would a foreign bank be short silver in a bull market? Are they stupid? Do they like losing money? No. Banks are in the business of making money. There are three likely reasons for this massive short position, and all of them are bullish for the physical price. Theory 1. The procurement strategy. If you are a foreign entity and you want to buy a massive amount of physical silver without sending the price to the moon immediately, how do you do it? You use the futures market to cap the price. You short the paper market to keep the price down while you scoop up the physical metal through the back door. You use the paper loss as a cost of doing business to acquire the physical asset cheaply. This is a classic raid tactic. You suppress the price to buy the inventory. Theory 2. The inventory hedge. Maybe these banks are holding massive amounts of physical silver for their clients, sovereigns, industrial giants, and they are shorting the paper market to hedge the value. If they are holding the physical, a short position isn't a bet on the price going down, it's insurance. This would imply that there is a massive stockpile of silver being accumulated by foreign hands that is being taken off the market. Theory 3. Structured products. The banks act as bookies. Their clients, wealthy investors, hedge funds, want to be long silver. So the bank sells them a swap or a derivative that is long silver. To protect themselves, the bank has to go short in the futures market. This means the massive short position is actually a reflection of massive long demand from their clients. The bank is just the middleman. Whichever theory is true, the result is the same. The short position is not a sign of bearishness. It is a sign of massive activity and accumulation. And despite this massive short position, the price is rising. The shorts are trapped. If the price keeps going up, these foreign banks will face margin calls. They will be forced to cover. And when a massive short position covers, it becomes a massive buy order. This is the fuel for a short squeeze. We are sitting on a powder keg. Now let's leave the paper casino and go to the real world. The physical inventory. Look at the COMEX warehouses. We have two categories of silver, registered and eligible. Registered is the metal that has a warrant attached to it. It is ready to be delivered to fulfill a futures contract. It is the available supply. Eligible is just metal sitting in the vault that belongs to someone. It is not for sale unless the owner decides to sell it. Registered inventory is bleeding. It is dropping to levels we haven't seen in decades. As the price goes up, you would expect people to sell their silver into the market, increasing inventory. But the opposite is happening. Inventory is falling. This means the buyers are taking delivery. They are taking the metal out of the registered category and moving it to eligible, or taking it out of the vault entirely. This is a run on the bank. The holders of paper contracts are realizing that there isn't enough metal to back the paper, so they are rushing to grab what is left. It is a game of musical chairs, and the music is about to stop. When registered inventory hits critical lows, the COMEX loses its ability to set the price. The pricing power shifts to the physical market, to the dealers, the refiners, and the miners. That is when we see the price disconnect, where spot is $100, but you can't buy an ounce for less than $150. We are also seeing sticky industrial demand. This is a crucial concept. In the past, when silver prices rose, industrial demand would drop because manufacturers would switch to cheaper alternatives. But today, there are no alternatives. You cannot build a high-efficiency solar panel without silver. You cannot build an advanced microchip without silver. The demand is inelastic. This means that even as the price rises to $100, $200 or more, the industrial buyers have to keep buying. They are captive customers. This creates a floor under the price. The speculators might sell, but the industry cannot. This sticky demand acts as a ratchet. It allows the price to go up but prevents it from crashing back down. It creates a structural deficit that can only be resolved by much, much higher prices to stimulate new mining, which takes 10 years, or recycling, which is expensive. The logistical bottleneck is the final piece of this puzzle. Even if there is silver above ground, it is often in the wrong form. It is in 1,000-ounce industrial bars. Retail investors want 1-ounce coins and 10-ounce bars. The refining capacity to convert big bars into small products is limited. The mints are running at full capacity. When a raid happens, the mints get overwhelmed. They cannot produce enough coins to meet the demand. This causes premiums to explode. We saw this in 2020, and we are seeing it again now. The spot price might be one thing, but the cost to fabricate and deliver the product is rising. This adds another layer of cost that the consumer has to pay. It validates the higher prices. So, where is this going? The video mentions a path to $1,000. To the average person, that sounds insane. Silver at $1,000. That's a 10x or 20x move from recent levels. But you have to adjust your thinking for the reality of currency debasement. In Weimar Germany, the price of a loaf of bread went to billions of marks. Did the bread become more valuable? No. The mark died. If the US dollar loses its reserve status, or if the debt spiral forces hyperinflation, $1,000 silver is conservative. Adjusted for the real inflation of the 1980s peak, silver should already be hundreds of dollars. The $50 all-time high from 1980 and 2011 is a nominal number. In real purchasing power terms, silver is incredibly cheap. The raid by foreign buyers suggests they know this. They know the dollar is on borrowed time. They are exchanging their surplus dollars for hard assets while the exchange rate is still favorable. They are front-running the collapse. Now, I want to talk about the psychology of the raider. If you are a foreign bank raiding the US market, you are ruthless. You don't care about the sentiment of the American retail investor. You use volatility as a weapon. You smash the price down in the middle of the night to trigger stop losses. You create panic to shake out the weak hands. Then you buy the dip. You, the individual investor, are the target of this psychological warfare. They want you to sell. They want you to get scared by the volatility. They want you to look at a $5 drop and think, it's over. Do not give them your silver. Do not be the victim of the raid. Be the partner of the raid. Sit on the same side of the table as the foreign banks. Hold your position. The weekly close is a key indicator to watch. The raid creates noise during the week, but the weekly close tells the truth. If we see silver closing consecutive weeks above key psychological levels like $90, $100, it means the breakout is sustained. It means the raiders are holding their ground. Do not get distracted by intraday noise. Zoom out. Look at the weekly and monthly charts. The trend is vertical. We also need to consider the geopolitical dimension. Silver is a strategic metal. It is used in Tomahawk missiles, torpedoes, satellites, and drones. In a world of rising conflict, access to silver is a matter of national security. The U.S. Department of Defense has admitted that there are strategic shortages of critical minerals. If the U.S. government realizes that foreign entities are raiding the silver supply, they might react. They might declare silver a strategic asset. They might restrict exports. They might even nationalize mines. This would be the ultimate supply shock. If the U.S. government enters the market as a buyer of last resort to secure strategic reserves, the price becomes irrelevant. Supply vanishes. This is the force majeure scenario. It is a tail risk, but a growing one. The foreign banks know this. That is why they are raiding now before the walls go up. So what is the strategy for you? First, recognize the game. The game is accumulation. The price is just a mechanism to facilitate transfer. The banks are accumulating. You should be too. Second, ignore the paper price when it dips. A dip in the paper price is an opportunity to buy physical at a discount, if you can find it. It is a gift from the raiders. Third, watch the premiums. If the spot price drops $5, but the price of a silver eagle stays the same, meaning the premium rose 5, the market is telling you the drop is fake. The physical market is rejecting the paper price. Follow the physical market. Fourth, diversify your storage. If this rate intensifies, centralized vaults could become targets for government confiscation or bail-ins. Holding metal in your own possession or in a private non-bank vault in a safe jurisdiction, like Singapore or Switzerland, is prudent. Do not leave your eggs in the basket that is being raided. Fifth, prepare for the mania phase. We are leaving the stealth phase and entering the awareness phase. The mania phase comes next. This is when the public gets involved. This is when your Uber driver buys silver. This is when the price goes parabolic. The foreign banks will sell into the mania. You should have a plan to do the same. Not to sell everything, but to rotate into other undervalued assets, like land or cash-flowing businesses, when silver becomes historically overvalued. But we are far, far from that point. The raid on the U.S. silver market is a signal that the U.S. dollar's hegemony is ending. The foreigners are taking their ball and going home, and their ball is made of silver. The U.S., with its massive debt and printing press, is being left with the paper. The path to $1,000 is not a straight line. It will be volatile. It will be scary. There will be 30% corrections that make you question everything. But the fundamental drivers, supply deficit, monetary debasement, strategic hoarding, are stronger than ever. The fortress has been breached. The raiders are inside. They are grabbing every ounce they can find. The question is, are you going to let them take yours? Or are you going to stand your ground and ride this wave to generational wealth? This is not a drill. The data proves it. The open interest proves it. The inventory drawdowns prove it. The bank positioning proves it. The raid is real. I want you to think about the timeline. These banks operate on quarterly and annual cycles. They are positioning for the next 5-10 years. They see the energy crisis. They see the debt cliff. They are getting ready for a world where net zero meets zero trust. In that world, silver is the currency of energy and the currency of trust. Do not underestimate the sophistication of these buyers. They are not gambling. They have teams of analysts, satellite data on mines, and inside information on government policy. If they are aggressively positioning in silver, it is because they have high conviction. You can draft behind their conviction. Let's talk about the short squeeze potential again. The structure of the market is set up for a squeeze that could rival GameStop or Volkswagen. If the eligible inventory dries up and the registered inventory hits zero, the COMEX defaults. They will have to settle contracts in cash. They will say, sorry, we don't have the silver. Here's a check for the last traded price plus 10%. If that happens, the paper market dies. The price discovery moves instantly to the physical market, and the physical price will double or triple overnight. Anyone holding paper will get a cash settlement that is worthless compared to the real asset. Anyone holding physical will name their price. This is the black swan event that the raiders are positioning for. They want to be the ones holding the metal when the music stops. You have a seat at the table right now. The price is still accessible. The metal is still available with some effort. But the clock is ticking. The raid is accelerating. Every time you see a violent spike in price that refuses to correct, remember this video. Remember the raiders. Remember the fortress. The walls are crumbling. The old guard is losing control. The free market is breaking through. And the free market says silver is worth a lot more than $30 or $50 or $100. The path is clear. The destination is higher. The only variable is your resolve. Can you hold through the volatility? Can you ignore the noise? Can you see the raid for what it is? A desperate grab for real assets in a dying fiat system? If you can, you will win. Stay alert. Watch the weekly closes, watch the inventory levels, and keep stacking. The raid is on, and you want to be on the side of the raiders.